Welcome to the deep dive. Today, we are strapped in and ready for quite a ride. We're diving into a stack of sources that are just buzzing with insights into some really explosive shifts happening right now, economically, financially, geopolitically.
Absolutely. We're going DUP today. We're looking at, the very bedrock of the financial system, the bond market, but also trying to understand these big public clashes between major figures and, importantly, how it all connects.
Right. Our mission, as your AI hosts pulling all this together, is really cut through that noise. We process the data, the analysis from all these sources, and give you the key takeaways. We want you to quickly grasp what these warnings mean, what the research shows about global debt, and yeah, how does a feud between, say, Trump and Musk actually fit into this bigger picture?
Yeah, we've pulled together insights from, top financial minds like Jamie Dimon, the economist Lynn Alden, plus market watchers' detailed reports. It covers high-stakes conflicts, deep structural economic issues. It's a lot, but when you see it synthesized, the patterns are, well, pretty stark. And honestly, quite fascinating.
Exactly.
Yep.
Analytical, deep, but also hopefully really engaging. This is the stuff that shapes your financial world, so understanding it is key. Okay, let's get into it.
And, before we jump into the bond market chaos, just a quick word. This deep dive is brought to you by blockchaincompany.info, our media platform.
That's right. And we're really thrilled to have sponsors like 4IR Utility Token and 4IR GPT. We definitely encourage you to check out the 4IR utility ecosystem. You can find out more by popping over to 4IRtoken.com.
And definitely sign up for 4IRGPT.com. It's their flagship platform, really groundbreaking for AI knowledge exchange and trading. Think of it as a place where intelligence and expertise aren't just shared, but potentially monetized, too.
It's a really neat idea, actually. You can start monetizing what you know today. You create these things called prompts of intelligence based on what you're an expert in.
Yeah.
It's like packaging your insights so others find them valuable, and you get rewarded for it.
And listen, if you're a content creator, maybe you have a YouTube channel. Signing up for 4IRGPT.com could be a really significant extra revenue stream. You can tell your audience about your 4IRGPT channel in your videos, get deeper engagement, maybe attract paying subscribers who want that specialized knowledge.
Plus, promoting your channel on 4IRGPT actually helps boost your main YouTube channel, too. You get visibility in that community, maybe draw new folks back to your videos. It's smart cross-promotion.
And keep an ear out, because we'll be announcing more 4IR credits giveaways soon. These are designed to help you level up your skills in prompt media engineering on the 4IR GPT platform. It's all about empowering you in this, new AI world.
So yeah, take that step. Go to 4IRtoken.com, learn about the ecosystem, then sign up at 4IRGPT.com. You get 10 free credits right away just for signing up. Perfect for getting your first prompt media channel off the ground. Explore it.
And please, if you find these deep dives valuable, hit that subscribe button on the BC Podcast's YouTube channel. It really helps us keep doing this analysis, and it keeps you posted on future 4IR credits and news.
Okay, thank you for listening, and a huge thanks to our sponsors. Right, let's dive in. We're starting with what many sources point to as maybe the most critical financial nerve center right now, the bond market. And we're not easing in gently. The reports start with some incredibly blunt warnings.
Yeah, you really have to pay attention when someone like Jamie Dimon speaks up. He's the CEO of JP Morgan Chase, right?
Yep.
They manage something like $4 trillion in assets. I mean, that number alone.
4 trillion. Wow.
And his warning was, well, it wasn't subtle. He said, and I'm quoting here, "You are going to see a crack in the bond market. It is going to happen and you're going to panic."
You're going to panic. Coming from him, that just hits differently. It tells you how serious he thinks this is.
Right.
And we need to understand why a crack in the bond market is such a big deal. This isn't some, risky penny stock.
Exactly. The bond market is supposed to be the safe place, the bedrock. It's what pensions are built on. It's where your retirement savings often sit. It's how governments fund themselves. If that starts cracking,
The whole structure feels shaky.
precisely. It affects everyone, even if you don't directly own bonds, because it hits the institutions you depend on, it hits the economy you live in.
And the sources are clear. This isn't just Emma worrying about the future. There are signs of strain, these potential cracks, showing up now, both overseas and right here at home.
Okay, let's take an international example they mention. Japan. Japan, for years, decades really, was seen as this pillar of financial stability, a huge global creditor. But even their bond market is showing, well, serious stress.
How so?
Specifically, the value of their 30-year government bond, it's dropped massively. We're talking like 45% in just the past year.
45%
Yeah.
on a 30-year government bond in 1 year. That's wild.
It is. And at the same time, the interest rates, the yields on those bonds, shot up 100 basis points. This isn't just numbers on a screen. It caused huge unrealized losses for major Japanese life insurance companies. They hold tons of these long-term bonds. So that's a major warning signal from a place long considered ultra-stable.
Okay, so turning to the U.S., the story here is maybe less about a sudden drop like that, but more about the sheer scale of our debt and how we're adding to it. Sources flag the national debt now topping, what, $36 trillion?
36 trillion. And that puts our debt relative to the size of our economy, the debt to GDP ratio at around 124%, which historically and compared to many other developed nations is very high. Our outstanding IOUs are bigger than our entire yearly economic output.
But it's not just the total, right? It's the speed we're adding to it. The sources talk about these persistent yearly deficits, over 6% of GDP.
Yeah, and that's key. Economists usually think around 3% is, sustainable long-term for a healthy economy.
So we're running deficits more than double that sustainable level, year after year.
And here's the kicker, according to the analysis, borrowing at over 6% of GDP. That's the kind of spending you usually see when an economy is in a deep recession. Government throwing money at the problem to simulate things, help the unemployed.
But, and this is the disconnect, the sources highlight, our job numbers don't look like a deep recession. Unemployment's been historically low.
Exactly. The government is spending and borrowing like it's an emergency, even though key indicators like employment suggest it's, well, not that kind of emergency. This mismatch is a big reason why investors are getting uneasy. They see fiscal behavior that doesn't line up with the economic reality, and it raises questions about long-term health.
Okay, let's pause for a second on the mechanics. Bond prices, yields, interest rates. The sources explain this relationship is crucial.
Super crucial. It's an inverse relationship. When people talk bond yields or interest rates, that's the return you get for lending the money, right, to the government in this case. The key thing is bond prices move opposite to yields.
So if interest rates on new bonds go up, the price of the older bonds you already hold has to go down to make its lower rate competitive.
You got it. If you bought a bond paying 1% and now new bonds pay 5%, nobody wants your 1% bond unless its price drops enough to effectively give the buyer a 5% return overall.
Okay, and that brings us to another major issue, the sources flag. The incredible speed of the recent rise in U.S. interest rates. The 10-year Treasury yield, that's a benchmark for everything from mortgages to business loans, it went from under 1% in 2020 to nearly 5% now.
Almost 5%, and it wasn't a slow climb. The sources call it the fastest jump in 40 years. That speed is what creates intense pressure.
Pressure on who?
Well, think about banks, financial institutions, even the government itself. They hold trillions in bonds bought back when yields were super low. Suddenly, market rates are way up at 5%. The market value of all those old, low-yield bonds plummets. This creates massive paper losses, unrealized losses on their balance sheets, just like those Japanese insurers, but potentially on a much bigger scale here. That's the crack Diamond was worrying about.
Right, so rates are up fast, causing pain. But why are they going up so fast? Sources point to investor doubt.
Yeah, this is fundamental. Investors buying government bonds are assessing risk. Can the government actually pay the interest year after year and eventually pay back the principal? When the debt level explodes and deficits stay high even in good times, investors start demanding a higher return, a higher yield to compensate for what they see as increased risk.
It's like lending money to a friend, right? If you totally trust them, maybe you lend at a low rate. If you're a bit worried, they might struggle to pay you back.
You'd want more interest. Exactly. So rising yields aren't just a technical thing. They reflect eroding confidence among the very people funding the government. And the sources stress, this isn't just happening in Japan. It's a major factor driving yields higher right here in the U.S., challenging that whole safe asset idea.
Okay, to really get under the hood of these structural forces, the sources really lean into the research from economist Lynn Alden. Her work offers a compelling way to see the long game here.
Lynn Alden's analysis, especially in her book Broken Money, uses charts that really clarify things. They're not just data. They show fundamental shifts. Her work helps explain why we're in this spot.
Let's walk through some of the key charts mentioned. The first one compares the government deficit to the unemployment rate, historically.
Right. And normally, these move opposite each other. Strong economy, low unemployment, smaller deficits, maybe even surpluses, recession, high unemployment. Deficits blow out. That's the normal cycle.
But Alden's research shows this relationship broke down. Sources say around 2017, deficits started rising much faster than you'd expect, even while unemployment was hitting 50-year lows.
This chart is so important. It shows the government borrowing like it's a recession during good times. It points to a structural deficit, not just a cyclical one. It suggests an inability to balance the books even when things are okay, which means debt piles up faster, making investors nervous, demanding higher rates. It kind of throws the old fiscal policy playbook out the window.
Yeah, her next chart is also pretty eye-opening. It looks at real interest rates versus the price of gold. Remind us what real interest rates are again.
Sure, you take the nominal rate, like the 10-year Treasury yield, and subtract inflation, usually the CPI. It tells you your actual return after inflation eats away at your purchasing power.
And historically, real rates and gold move opposite each other.
Pretty consistently, yeah. High real rates mean bonds are beating inflation nicely, so people favor bonds. Low or negative real rates mean bonds aren't keeping up with inflation, so people look for other stores of value, and gold often shines then.
But the source says there was a major decoupling in 2022-2023. Gold went up even when real rates were rising.
Exactly. And that's a big red flag, according to this analysis. Investors weren't acting like they used to. Even as real rates recovered a bit from lows, money wasn't flooding back into bonds. It was still favoring assets like gold, things governments can't just print more of. It suggests a deeper worry about the whole financial system, about the future value of currency itself, which is tied to government debt management. Confidence in traditional debt might be fraying.
That ties into our third chart, which compares private debt households and businesses with public government debt growth.
Yeah, the historical norm was private debt grew faster during booms. Government debt growth mainly spiked during downturns.
But that shifted after the 2008 crisis.
Big time. Since '08, government debt growth has pretty consistently outpaced private debt growth, even during expansions. This chart basically shows the government becoming the main borrower driving nominal GDP growth, borrowing like it's a crisis year after year. This creates this constant, massive need to issue new debt, raising those same questions. Who's going to buy it all, and at what price?
Which leads us to maybe the most powerful chart highlighted. U.S. federal debt to GDP versus interest rates going back decades.
This one tells a huge story. Back in the '80s, debt to GDP was low, maybe 30%, but interest rates were sky-high, double digits. Since then, for 40 years, the debt ratio soared 30%, up to over 120% today. But interest rates generally fell, hitting almost zero.
And that falling rate trend made the rising debt seem okay. Like, you owed more, but the payments were getting cheaper relative to the loan side.
Exactly. It was like refinancing your giant mortgage constantly at lower rates. Kept the payments from exploding. But as the sources stress, we've hit a massive turning point. Rates can't really go lower, and now, thanks to inflation and investor doubt, they're rising again.
And that's the problem today, right? With debt over 120% of GDP, the highest since World War II. Even small rate hikes mean huge increases in the actual dollars the government has to pay just in interest.
The analogy used is sharp. Young people look at 15% mortgage rates from the '80s and say, how did they afford that? Well, the house cost peanuts back then. Today, the national debt is enormous. So even 5% or 6%, which sounds low compared to the '80s, becomes crushingly expensive when applied to 36+ trillion. This spiraling interest cost is squeezing budgets and driving those persistent deficits.
And this need for constant government borrowing isn't just about spending choices. It's also linked to demographics, specifically the Social Security Trust Fund situation Alden raises.
Right. The trust fund was meant to bridge the gap as boomers retired. It grew, peaked around 2017 at maybe $3 trillion. But now, sources say it's drawing down fast, projected to hit zero within about a decade.
Because the huge baby boomer generation is retiring and drawing benefits.
That's the main driver, plus the fact that the fund was mostly invested in those low-yield treasury bonds we talked about. So as boomers retire, the government has to pay benefits. To do that, they sell the bonds from the trust fund, draining it quickly.
And since those benefits are legally guaranteed, the money has to come from somewhere, even when the fund is empty.
Precisely. Which puts the government in a bind. Raise taxes significantly, cut benefits drastically. Both are politically toxic. So the path of least resistance tends to be borrow the money.
Which means issuing even more bonds, adding even more debt, reinforcing that whole cycle, and putting more pressure back on the bond market. It shows a big chunk of the borrowing isn't discretionary, it's baked in structurally.
And all this analysis, the charts, the debt levels, the structural issues, leads to this really confronting idea from Alden, described in the sources as the debt Ponzi.
Debt Ponzi. That sounds unstable.
It's meant to be provocative, but the core idea as laid out is that the current system essentially needs two things just to keep from collapsing. One, constant increasing borrowing across the whole economy, total debt, and two, continuous money printing by the central bank expanding the monetary base.
And the tail's immense. Sources mentioned total U.S. debt, government, corporate, household at around $100 trillion.
$100 trillion. And get this statistic. Total debt in the U.S. has only decreased in 5 years out of the last 110. 5. 4 during the absolute worst of the Great Depression, and a tiny blip in 2008. Every other year, it grew.
Wow. That really hammers home how reliant the system is on just growing the debt pile.
And when you compare that $100 trillion debt to the much smaller monetary base, physical cash, plus bank reserves, you see incredible leverage. Back in 2008, debt was maybe 50 times the base. Today, the leverage is enormous.
And the scary part of the Ponzi idea is, if you try to actually reduce that $100 trillion debt pile significantly or quickly,
you risk triggering a deflationary collapse. The system is so leveraged it can't handle rapid deleveraging without a massive shock. That's the Ponzi aspect.
Yeah.
You need constant new money, borrowing, and an expanding base, printing, just to service the existing debt structure, because actually paying it down is almost unthinkable under current conditions. And this feeds back. More printing risks inflation, investors demand higher bond yields, straining the debt system further.
Okay, so has anything like this happened before? Sources look at historical parallels, especially the shift after World War II in the 1940s.
Yeah, that's a really interesting comparison. In the lead up to the Great Depression, you had unsustainable private debt blowup. Then, the government stepped in massively, first for the Depression, then hugely for the war. This shifted the economy's reliance from private debt to government debt.
So after WWII, the U.S. government had massive debt relative to its economy, kind of like today's high debt to GDP. How did they handle that? They didn't just pay it off, right?
No. The main strategy was something called financial repression. Basically, over decades, they used policies to keep interest rates artificially low, often below the rate of inflation. This, combined with economic growth, slowly eroded the real value of that debt. Inflation made the old debt worth less over time. They gradually shifted the burden back towards the private sector.
So history offers a potential playbook, but it needed specific conditions: low rates, inflation, growth.
And that's the problem highlighted today. The conditions are totally different. Back then, they could push rates down. Now, rates are rising from near zero. They had a post-war boom and favorable demographics. Now, demographics are a headwind with Social Security draining.
And financial repression needs inflation to run higher than interest rates. Today, inflation is the problem policymakers are fighting with higher rates, not a tool they're using to inflate away debt.
Exactly. So while we've seen debt cycles before, the sources argue the tools and conditions that worked after WWII just aren't available now. Navigating today's debt mountain might require very different, potentially much more disruptive solutions.
This whole backdrop, the bond market stress, the structural debt issues, the historical context, really sets the stage for why the system might be more vulnerable to shocks now.
Which brings us to this really fascinating and potentially explosive catalyst the sources discuss, the very public conflict between former President Donald Trump and Elon Musk.
Yeah, this has become a full-blown war of words, a flame war, as some put it. Reports say it started deteriorating after Musk left Trump's advisory councils and later criticized Trump's big tax and spending package, the Big Beautiful Bill. Trump apparently said he was very disappointed in Musk.
And Musk, well, he didn't hold back in his response, according to these sources.
No kidding. He flatly denied supporting Trump's bill, called Trump ungrateful, and even claimed Trump wouldn't have won in 2020 without his help, implying financial support or maybe swaying some voters.
He also hit Trump on policy, specifically tariffs, arguing they'd cause a recession, which, coming from Musk as head of Tesla, an auto giant, carries some weight in that debate.
And then Musk dropped that bombshell allegation. Sources report him claiming Trump is named in the Jeffrey Epstein files, and that's why they weren't released sooner.
Yeah, that allegation just ignited everything online. It took the feud to a whole different, very charged level. Completely unprecedented, really.
And Trump's counter. Equally powerful, especially given his potential return to office. Sources quote him suggesting the government could save money by simply terminating the billions and billions of dollars in contracts and subsidies going to Musk's companies.
And boom! Suddenly, a political spat slams right into hard economic reality. Sources point to the immediate market reaction. Tesla stock reportedly took a big hit, dropping somewhere between 14% and 18% intraday after this blew up.
That's a massive move for a company like Tesla, clearly showing the market pricing in this political risk. It highlights why this isn't just gossip. Tesla's public. And SpaceX, though private, is deeply, deeply tied to the government.
The sources lay out just how tied. SpaceX and Tesla together have received something like $25 billion in government subsidies, grants, contracts since 2000. Think about SpaceX's defense contracts, NASA launches.
So when Trump threatens to cut those off, it's not just talk. He's threatening a multi-billion-dollar lifeline, especially for SpaceX, which relies heavily on those government payloads.
Absolutely. SpaceX dominates commercial launch. It's vital for getting U.S. astronauts and critical satellites, including national security ones, into orbit. Musk himself needs security clearance. The company deals with strict regulations like ITAR. Threatening those contracts puts immense pressure on a company that's frankly become strategic infrastructure for the U.S.
Sources also mention this creates a kind of negative association around Musk personally. This political heat can spill over onto all his businesses, making things harder, especially when dealing with regulators or government agencies.
And there are broader political ripples, too. Musk has influence, Trump has influence. This feud could shake up alliances. Sources mention figures like Mark Andreessen or David Sachs, maybe indicating shifting support bases that this conflict could disrupt.
Plus, it hits their lobbying. Sources note Musk's team is actively lobbying on things like autonomous driving rules crucial for Tesla's robotaxi ambitions. A public fight with a major political figure makes that job a lot harder.
So yeah, what looks like a personal feud quickly becomes a tangle of financial risk, corporate strategy, and even geopolitical implications. It really underscores how interconnected power, politics, and money are right now.
Okay, given all this, the debt issues, the bond market strains, the potential for political conflicts to act as economic shockwaves, let's look at how some sources approach investing in this climate.
One strategy discussed involves diversifying pretty broadly, something like putting money into the U.S. stock market, say via an ETF like VTI, but also holding Bitcoin, real estate, and keeping a decent chunk, maybe 20–25% each, in cash.
And the thinking behind including hard assets like gold or Bitcoin specifically.
It comes back to the risks we've discussed. If there's instability, if governments resort to more money printing to handle debt, that debt Ponzi idea, then assets with limited supply, like Bitcoin, could hold their value or even increase significantly as the currency potentially devalues. It's positioned as a hedge against that monetary expansion risk. Not owning them might be the riskier move, in this view.
Then you have perspectives like Kathy Wood's highlighted in the sources. She sees a huge, big shift coming, maybe the next 5 years.
Right.
Companies either adapt to massive disruption or they could really struggle, even crash.
Right, and her focus is squarely on those disruptive technologies. AI is huge for her, and Tesla is a key holding, obviously.
She's famously bullish on Tesla. Sources mention predictions of it potentially 10xing in 5 years, driven by autonomous taxis and humanoid robots. Big bets on disruption.
Yeah, and her views on AI's broader impact are pretty dramatic, too. Potential for higher unemployment as AI takes over tasks, and that prediction about coding, no code will be written by humans in 5 years. That's a bold statement about AI's trajectory.
And she's also very bullish on Bitcoin, right? Sources mention that wild $1.5 million price target by 2030 and investing in platforms like Coinbase. So another strong vote for crypto as a major part of the future financial landscape.
Definitely. But importantly, the sources also present the other side of the Bitcoin coin. One piece specifically warns about Bitcoin's biggest risks, suggesting it could face a major collapse, maybe around 2025.
What kind of risks are implied there?
The text doesn't detail them fully, but the core idea seems to be. As Bitcoin gets bigger and attracts more institutional money, the incentives and ability for powerful players to potentially manipulate or exploit its weaknesses also increase. There's also the argument that Bitcoin might not be the perfect safe haven in a true market meltdown. The idea is that its real fair value isn't based on traditional metrics like cash flow. Maybe it's more based on faith or narrative right now. So a big market crash could force a painful price discovery for Bitcoin itself rather than it just acting as a shield.
So you have these really divergent views on Bitcoin's role, crucial hedge versus potentially vulnerable asset. It really highlights the uncertainty in the range of strategies people are considering.
And weaving all these threads together, the debt, the bond market, the potential Trump-Musk trigger, the investment debates, the sources inevitably raise this big, slightly ominous question about a potential major economic event.
Yeah, one source explicitly draws parallels to the 1920s, that era of excess before the 29 crash, the Great Depression, and eventually WWII.
And it points to Germany's massive Weimar debt after WWI as maybe a starting point for that whole global destabilization.
Yeah.
The implication being, could America's huge debt today play a similar role?
Which leads to the unavoidable question the material poses. With 36 plus trillion in debt, government borrowing described as potentially Ponzi-like, rising rates squeezing the system, and unpredictable shocks like political feuds or geopolitical crises. What could actually trigger a major market correction, say 30% down, or even a devastating crash, maybe 75% or more?
The potential triggers mentioned are varied. Could the Trump versus Musk fight actually be the spark, given the strategic importance and government funding involved? Or is it more likely to be one of the big geopolitical hotspots, Russia-Ukraine, the Middle East, tensions with China?
Any one of those, hitting a system already stressed by debt and rising rates, could theoretically be the catalyst that tips things over.
As we wrap this up, the sheer interconnectedness is just undeniable, isn't it? Government debt hits the bond market, which hits the whole financial system. Political fights become economic risks, especially with key industries involved. And all of it shapes how investors see the future.
It really hammers home that idea that maybe this reliance on ever more debt isn't just a background issue. Maybe it's a core vulnerability, a crack waiting for the right pressure.
Yeah, the combination of these deep economic issues, the financial pressures, and the sheer unpredictability of politics and world events. It definitely creates an environment that, well, requires paying very close attention.
And understanding these complex forces is exactly why we do these deep dives. We really hope this journey through the sources has given you some valuable perspectives.
And remember, this deep dive, digging into these crucial global shifts, was brought to you by blockchaincompany.info, our media platform.
We're so grateful for the support of our sponsors, 4IR Utility Token and 4IR GPT. Please do check out the tools they offer to help you navigate this complex world.
Visit 4irtoken.com to learn more, and definitely sign up for 4irgpt.com.
It's your chance to get involved with prompt media engineering, maybe even turn your own knowledge into something valuable in this new AI era.
Plus, you get those 10 free credits just for signing up at 4irgpt.com. It's a great way to start exploring and set up your own prompt media channel right away.
And for you YouTubers listening, seriously consider 4IR GPT. It's a way to offer more to your audience, potentially create a new revenue stream, and even boost your main channel's visibility.
And please subscribe to the BC Podcasts YouTube channel. It helps us immensely, keeps you updated on our deep dives, and you'll hear about future 4IR credits giveaways too.
Also, if your company is interested in sponsoring content like this and reaching our audience, get in touch through our YouTube account or 4irgpt.com. We can even talk about creating custom spotlight podcasts for your brand.
Thanks again to our sponsors, and thank you, our listener, for sticking with us through this deep dive.
So just to quickly recap the big themes we pulled from the sources today, we started with those stark warnings, like Jimmy Dimon's, about potential cracks in the bond market, the very foundation driven by massive global debt.
Then we dove into Lynn Alden's research, using those charts to show how structural this debt problem is, how the economy seems hooked on borrowing, even in good times, and why the old post-war solutions might not work now. That debt Ponzi concept really sticks with you.
We then pivoted to that high-profile Trump-Musk conflict, seeing how quickly personal politics can become a major economic risk, hitting stocks, threatening huge government contracts, and shaking up political landscapes.
And finally, we touched on different ways people are thinking about investing through this, diversifying, betting on disruption like AI and Tesla with Cathie Wood, or holding assets like Bitcoin as a potential hedge, while also acknowledging the significant risks and counter-arguments around crypto.
And underlying it all is this idea that the system's deep reliance on constantly growing debt could be its Achilles heel, a fundamental vulnerability.
Right. You've got the structural economic weaknesses, the rising financial pressures from rates, and then these unpredictable political or geopolitical sparks. It creates this sense of fragility, at least from some perspectives in the sources.
Which leaves us with this final thought for you, the listener, to chew on. Given everything we've discussed, the structural debt issues, the stressed bond market, the potential triggers like politics or geopolitics, are we actually heading towards some kind of necessary reckoning, a major market correction, or maybe something bigger? Or is the most likely outcome still just finding ways to, kick the can down the road, manage the debt somehow, maybe inflate part of it away, delaying the final bill indefinitely?
And maybe the core question for you is, how does understanding these deep interconnected forces, The debt, the politics, the potential disruptions change how you view the future. How does it shape your thinking about risk, about stability, about your own financial path in this really dynamic and maybe uncertain global picture?
We really encourage you to mull over these perspectives, dig deeper where you're curious, and keep exploring these critical issues. Thanks so much for joining us on the Deep Dive.